Okay, so let's start with something that I think most people have seen, but maybe don't fully grasp just how powerful it is.
Mm-hmm.
The tax credit. You look in your tax return, you see this big number you owe,
Yeah.
say $5,000.
The scary number. Yeah.
The scary number. And then, boom, you apply this thing, and suddenly you only owe $2,000. It's a direct hit to your tax bill.
It's a surgical strike. That's the perfect way to put it. I mean, we're all pretty familiar with the tax deduction, right? That just lowers your taxable income, so you're taxed on a smaller amount of money.
Right, a smaller pot.
Exactly. But a credit, as you said, it's a dollar-for-dollar reduction of the actual tax you owe. If you have a $1,000 tax bill and a $1,000 tax credit, you owe nothing, zero. It's pure direct value.
And that purity, that directness, is what makes it such an incredible tool for social and economic policy. This isn't just some accounting trick. It's actual state power delivered right through the tax code.
100%. And for this deep dive, our source material is it's vast. It gives us this incredible global perspective. We've got everything from the huge renewable energy incentives in the U.S. to credits for, adoption and education.
And then there are these really specialized things like the VAT credit, which is fundamental to how Europe works. And then these highly charged political systems like the low-income assistance they used to have in the UK.
It's a huge range.
So our mission today is to get way past that surface-level definition. We want to really uncover the political machinery behind it, the economic drivers, and the, frankly, incredible social engineering power that tax credits have. I think by the end of this, you'll see a tax credit isn't just a number on a form. It's a government mandate.
All right, let's start with the absolute foundation, because the mechanics here, they really determine whether you're getting simple tax relief or a direct cash payment from the government. So what is the core, simplest definition? Okay, at its most basic, a tax credit is an incentive. It lets you subtract a certain amount directly from the total tax you owe the state. It's basically a rebate or a kind of government discount.
Right.
And our sources really break these down into three main buckets. They're either an incentive to get you to do something, buy an electric car, or they're a recognition of taxes you've already paid during the year, or sometimes they're just a general discount from the state for social reasons.
That first distinction we made, credit versus deduction, that's vital. But the distinction within the world of credits is, I think, even more important. Yeah. We have to drill down on refundable versus non-refundable. This one detail is the key to everything.
You really can't overstate it. This is the hinge. This is the point that determines whether a taxpayer can get what's called a negative tax liability.
Which means the government actually writes you a check.
A check, even if you didn't pay in that much tax to begin with.
Okay, let's use the scenarios from the sources to make this super clear. Let's start with the most powerful one. Scenario A, the refundable credit.
Okay, so imagine a taxpayer. After all their calculations, they have a tax bill of $100. That's what they owe. Now, they qualify for a $300 refundable tax credit.
Okay.
Because it's refundable, the credit doesn't just stop when the bill hits zero, it keeps going. It wipes out the $100 owed and then pushes the final liability into the negative $200. That $200 difference, that is money the government pays back to the taxpayer.
So to be really clear, if you're a low-income worker, maybe you earned so little you didn't pay any federal income tax at all, or let's say only $50 was withheld from your paychecks.
Yeah.
You still get that $300 refundable credit.
You get the full $300, or, well, $250 back after covering your $50. The point is, that refundable piece transforms the tax code into a direct subsidy. It becomes a social safety net, and it's delivered super efficiently through the IRS or whatever the national tax agency is.
Now let's flip that on its head. Scenario B, the non-refundable credit. Same situation. You owe $100, you have a $300 credit. What happens now?
It's a totally different outcome. In the non-refundable case, the credit can only reduce your bill down to zero. So you pay nothing, which is still great, but you've only used $100 of that credit. The other $200, it's just gone.
It just disappears.
It just vanishes. Now, some specific credits might let you carry it forward to the next year, but the main point is no cash back. The tax bill cannot go below zero.
And there it is. That's the huge policy insight, right? Non-refundable credits, they mostly help people who already have a decent tax bill to begin with, middle and upper middle class, as an incentive for things like education.
Exactly. But the refundable ones, they are explicitly designed to put money into the pockets of the lowest income people, even people who might not file a tax return otherwise, except to claim that specific benefit.
One is relief, The other is a social payment.
Perfectly put.
Okay, let's hit that third foundational piece, which is less about incentives and more about just good bookkeeping. Credits for payments you've already made.
Right, these are really just accounting adjustments. They're designed to track money that's already moved from you to the government, and they're almost always refundable because it's your money you already parted with.
And the most common example for an individual is just payroll withholding, right?
Payroll withholding, exactly. PAYE, or pay as you earn, as they call it in the UK. Every paycheck, a little tax is taken out. At the end of the year, all those little payments are added up and credited against your final tax bill. If they took out too much, you get a refund. Simple.
Another big one in this bucket is withholding on payments to non-residents. How does that work?
So if a foreign company earns money in the U.S., for example, the U.S. company paying them is usually required to withhold a certain percentage of that payment and send it straight to the IRS.
Right.
The foreign company then uses that withheld amount as a credit against whatever their final U.S. tax bill is when they file their own return. It's a way to ensure the government gets its cut from cross-border transactions.
And then we get to the most complex one, the input credit for a value-added tax, or VAT. This is the engine that makes consumption taxes work in, what, over 160 countries?
Absolutely fundamental.
So walk us through the mechanics of an input credit. This is how the system avoids taxing the same thing over and over again, right?
That's exactly its purpose. Okay, so imagine a car manufacturer. They buy steel and they pay, let's say, 20% VAT to the steel supplier. That VAT they paid is their input VAT.
Got it.
Now, when they sell the finished car to a dealership, they collect 20% VAT on that sale price. That's their output VAT. They don't send all that money to the government. They only send the difference. The output VAT they collected minus the input VAT they already paid. The input VAT acts as a credit.
So if a business has a month where they buy a ton of new equipment but don't sell much, their input credit could be higher than their output VAT? Does the government owe them cash in that case?
Yes. And that's why these credits are usually refundable after a certain period. This is especially vital for any business that exports.
Why for exporters?
Because exports are almost always VAT exempt. They're zero rated. So an exporter pays input VAT on all their supplies and labor, but when they sell their product overseas, they collect zero output VAT. That means their entire input credit balance is owed back to them by the government. It's how you make sure your country's products can compete on the global market without being burdened by domestic taxes.
Wow. So we start with this simple idea, a tax reduction, and it immediately explodes into three totally different worlds: refundable social payments, non-refundable middle-class incentives, and these complex cash accounting systems for payroll and global trade.
No.
Okay, now we are moving firmly into what you called social engineering territory. Because at the individual level, this is where tax credits become these incredibly powerful and often really politically volatile tools for income redistribution. We're talking about credits that act as low-income subsidies.
Absolutely. And as we just established, these are almost always refundable. The key insight here is that when you deliver social support through the tax code, when you call it a tax credit instead of calling it welfare, you can often get, better political buy-in.
And probably higher uptake, too.
Exactly. People who might have a stigma about welfare often feel perfectly fine getting a tax refund.
We have two amazing case studies that show the full power and the volatility of this: the historical system in the UK and the system in the US. Let's start with the UK's old tax credits. That was a really unique experiment.
It was. The old UK child tax credit and working tax credit. They were explicitly a form of means-tested support. But here's the detail that's kind of shocking to an American perspective. They had absolutely no connection to how much tax the person had actually paid.
None.
And none. They were pure cash payments delivered through the tax system. You could be a non-taxpayer and still get thousands of pounds. They weren't tax relief. They were social subsidies that were just cleverly rebranded.
Let's get into the mechanics of the child tax credit then.
So there was a baseline minimum amount that was payable to pretty much anyone with kids, as long as their income was below a fairly high limit. But the calculation itself was incredibly targeted.
How so?
The amount you got depended on your income, obviously, but also the number of children you had, whether any of them received disability living allowance, and even the education status of your older kids.
Wow. So the state was really micromanaging family details to target the money. It sounds complex, but I guess it was theoretically very precise at finding need.
It was. And then you had the working tax credit, the WTC, layered on top of that. That was the employment incentive. It was paid to low earners. If you were single and over 25, you had to work over 30 hours a week. But if you had children, That work requirement dropped all the way down to 16 hours a week.
To encourage part-time work, especially for parents.
Exactly. It was trying to make work pay, even part-time work.
But the moment a system gets that complex and that many people depend on it, it becomes a massive political target. I imagine the controversy was inevitable when someone proposed cutting it.
Oh, it was huge. And the effects were immediate and measurable. Our sources cite a survey from the organization End Child Poverty, which estimated that when these cuts were proposed, it directly forced about 1.5 million parents to cut back on essentials. We're talking food, fuel, just to get by.
And the political rhetoric around this was fascinating. I remember the point from the Resolution Foundation. Their argument was that you can't just cut these credits and expect employers to magically raise wages to fill the gap.
Right. Their director called that saloon bar economics. He stressed that the credits were a necessary bridge, making sure low-paid work could actually provide a minimum standard of living, regardless of what the employer was paying.
And this all came to a head in Parliament, right?
It absolutely did. In September 2015, the House of Commons voted to slash the income thresholds for these credits, which meant a big pay cut for a lot of low-income working families, starting the next April.
And the opposition, what was their immediate claim?
That it would push the working poor deeper into poverty. And they weren't just guessing.
The Institute for Fiscal Studies, the IFS, backed them up with an analysis.
They did. The IFS confirmed that even when you accounted for other government policies happening at the same time, a small income tax cut, a rise in the national living wage, the net effect of cutting the tax credits was still a significant income loss for the poorest families. It really confirmed that the goal was to cut spending, even if it hurt those recipients.
And what was the government's rationale for that?
Their stated reason was that the system had just become too expensive, that it was being used for too long to subsidize low wages, and they needed to bring the spending back down to what they called sustainable 2007 levels.
But the fight wasn't over. This is where it gets really dramatic, with the House of Lords.
It does. In October 2015, in this highly unusual move, the unelected House of Lords actually voted to delay the cuts. They basically sent it back to the House of Commons and said, you need to reconsider the social damage this is going to do.
That's a huge political move. It just underscores how critical this tax mechanism was to people's income.
It was seen as essential income, not just a tax break. But in the end, the entire system, the child and working tax credits, was eventually phased out. It officially ended on April 5th, 2025, and was mostly replaced by the universal credit system. It just shows how these things are constantly evolving.
Okay, let's pivot now to the United States. Low-income support is also delivered through the tax code here, but it's dominated by one massive refundable credit, the Earned Income Credit, or EIC.
The EIC is really the bedrock of American anti-poverty policy. It's a refundable credit, and it's calculated as a percentage of the income you earn. But unlike some other credits, it's designed on a schedule that actively encourages work.
What do you mean by that? The schedule?
It starts small, but it ramps up very quickly as your income rises from zero. Then it hits a maximum plateau, and then it phases out gradually once you're above a certain income threshold.
That ramp-up part is critical, isn't it? It gives people a direct financial reward for going from no work to some work, or from part-time to more hours.
Precisely. You see a real tangible benefit as you work more. And to give you an idea of the scale, back in 2016, the maximum credit for a family with 3 or more kids was over $6,000. $6,269.
That's a huge cash injection delivered right through your tax return. It's one of the biggest anti-poverty programs in the U.S.
It is, and the amounts are indexed to inflation, so its value doesn't get worn away over time.
Beyond the EIC, the U.S. has a few other credits aimed at specific low-income groups.
Right. There's the non-refundable credit for the elderly and disabled. It's one of the older ones. It provides a relatively small fixed credit to low-income seniors and disabled people just to reduce their final tax bill if they have one.
And then there's the retirement savings contribution credit, which a lot of people call the saver's credit. This is a brilliant example of using a credit to steer behavior.
It's fantastic, and it's highly progressive. It's non-refundable, but it gives you a credit for up to 50% of the first $2,000 you contribute to an IRA or 401k. But here's the progressive part. The phase-out is really steep.
How steep?
For the 2014 tax year, it started phasing out for single people making just over $18,000. If you earn too much, you get nothing. So it's exclusively focused on helping those who need the biggest boost to start saving.
And finally, tying social goals directly to the tax code, there's the premium tax credit. This came in with the Affordable Care Act.
Yes, in 2014. This one is refundable. And it's for people who use the healthcare exchanges and have an income between 100% and 400% of the federal poverty line. It's a direct subsidy to help pay their health insurance premiums. The fact that it's refundable is key because it means even if you owe no tax, you still get the money to afford coverage.
The pattern is just so clear. From the UK to the US, when the goal is a direct social subsidy, refundable credits are the weapon of choice.
And we see that perfectly in Canada. Canada has this whole suite of super specialized credits that target almost every possible financial need or social goal you can think of.
So walk us through the Canadian model.
Well, they start with the Canada Child Benefit, the CCB. It's a tax-free monthly payment to help families with kids. It's just a pure support payment, more like the old UK system.
And then they have more targeted credits, right? Like for caregivers.
Exactly. The Canada Caregiver Credit, it's non-refundable, and it recognizes the unpaid labor of caring for a family member with an impairment. By making it non-refundable, it acts as tax relief for middle-class taxpayers who are bearing that cost.
And they have their own version of the EIC, the Canada Workers Benefit, which is refundable, and a non-refundable disability tax credit.
Right. And then you see credits aimed at the future. There's a refundable Canada Training Credit to help pay for upskilling. And then non-refundable ones like the Home Accessibility Tax Credit for modifying a home for someone with mobility issues, and a Medical Expense Tax Credit for high medical bills.
The sheer number of these specialized credits in Canada really shows you, if a government have a precise policy goal, the tax system is the most flexible, targeted delivery platform they have. Okay, so we're going to shift gears now. We're moving away from those low-income subsidies, which really depend on the refundable nature of the credits, and we're going to look at incentives that are aimed mostly at the middle and upper middle classes. And these almost exclusively use non-refundable credits.
That's a really important shift. Because these are non-refundable, they are, by design, for people who already pay a good amount of income tax. They aren't direct cash payments. They're incentives to spend your money in a way the government approves of.
Let's start with family relief in the U.S. And the big one is the child credit.
The child credit gives this really broad relief. It's up to $1,000 per child under 17. The policy goal is simple: helping with the cost of raising kids. It's a straight dollar-for-dollar cut to your tax bill.
But like pretty much every U.S. credit, it has these very specific phase-out limits. It's not for the super wealthy. The sources say that for every $1,000 of income you make over the limit, which is $110,000 for a married couple, the credit gets reduced by $50.
Which tells you exactly who this is for. It's a policy aimed squarely at the middle class. Once you get into the upper middle class and higher, that credit just fades away. It shows you the government's targeting mechanism at work.
Then there's the Child and Dependent Care Credit. It's also non-refundable, and this one reveals some really explicit government priorities about work.
It does. So this credit lets you claim a percentage of up to $3,000 in expenses for dependent care, daycare for a child under 13. But here's the big restriction. You have to incur that expense because you're working or looking for work.
Hold on. So if I work and I pay for daycare, I get the credit. But if my spouse is a stay-at-home parent who provides that care for free, we get nothing.
Exactly. That is the policy message, loud and clear. If one parent is at home full-time, the family gets no credit. So this credit isn't just about supporting kids. It's an explicit incentive to encourage dual-income households and get more people into the workforce.
That's fascinating.
Well,
Okay, moving to another family policy, the credit for adoption expenses. This one is also non-refundable and phases out for high earners. What's really striking here is how volatile the amount of the credit has been.
the historical numbers tell a story of political negotiation. The sources show that in 2011, the credit was worth over $13,000. It dropped a little in 2012, but then in 2013, it plummeted to just $5,000.
A drop from over 12 grand to 5 grand in 1 year. That's a massive policy change. Why would it drop so steeply?
It tells you that Congress was actively reevaluating just how much they were willing to subsidize adoption. It shows that these credits are not fixed entitlements, they are active year-to-year legislative choices. The volatility itself is the story here.
That idea of active choice brings us right to education subsidies. The U.S. has 2 major credits for education, but you can only claim one of them, which forces taxpayers to make a strategic choice.
Right. The first one is the American Opportunity Tax Credit, the AOTC. This came out of the 2009 stimulus package, the Recovery Act, and it replaced the old Hope Scholarship Credit. The goal was huge: get people to spend money on higher education right away.
And the calculation is pretty specific. It's a max benefit of $2,500 per student. How does that break down?
It covers 100% of the first $2,000 you spend on tuition and fees, and then 25% of the next $2,000. And here's the key. It was partially refundable up to $1,000. That made it a bit more progressive. And it was designed for those first 4 years of college.
But the sources say critics complained about the complexity. If the goal was immediate stimulus, how did complexity get in the way?
Because the eligibility rules, the paperwork you needed, and the fact you had to choose between two different credits. It meant a lot of people either claimed the wrong one or didn't even realize they qualified. So the actual benefit people got was often way lower than the theoretical maximum. Complexity can really kill the effectiveness of a policy.
And what's the alternative to the AOTC?
That's the lifetime learning credit. This one is purely non-refundable. It's designed more for ongoing education, like job training or grad school, not just that initial college push. It covers 20% of the first $10,000 of your total expenses. So it's less valuable per year, but much more flexible.
And just like the child credit, they both had income phase-outs.
Right. Starting at $50,000 for single filers back in 2009. Again, these are designed to help the middle class with rising tuition. The lowest income students are usually covered by direct grants, like the Pell Grant. These credits are for people who actually have a tax bill to reduce.
And finally, we saw credits for specific lifestyle goals or stimulus. The first-time homebuyer's credit comes to mind.
That was a pure economic stimulus play. It offered up to $7,500 to get the housing market moving during the financial crisis. But it was super time-sensitive. You had to close on your house before the end of September 2010. A classic example of using the tax code for macroeconomic steering.
And of course, the ever-present energy efficiency credits.
Yes, for things like new windows, insulation, solar panels. The rules on these change constantly because the technology is always changing. The complexity here is almost a necessary evil because the policy goal itself, getting people to adopt the latest, best technology, is a moving target.
So the bottom line for this whole section is pretty clear. Tax credits are the government's favorite tool for guiding how individuals spend their money, whether it's on family, education, or making your home more efficient. So if individual credits are all about social engineering, then business tax credits are all about economic engineering. We're talking about directing huge amounts of capital, leveraging billions in private money towards things the government sees as a public good.
That's the perfect way to frame it. These are incentives offered against income or property taxes to get businesses to invest in specific ways or in specific places. And because businesses can have enormous tax bills, these credits are usually non-refundable, but the unused part can often be carried forward for years to offset future profits.
The legislative intent here is so important. It's often called the but-for argument. The idea is that Congress is creating these incentives for investments that, probably would not occur but for the credits.
Exactly. The government is essentially co-investing with the private sector to get a public benefit.
Let's start with a credit that perfectly blends economics and public good. The Federal Historic Rehabilitation Tax Credit.
Right. This one is all about preserving and restoring historic buildings. It has a two-tier structure that came out of the 1986 Tax Reform Act.
What are the two tiers?
There's a 20% credit for the certified rehab of a truly historic building, which encourages really careful, expensive restoration. And then there's a smaller 10% credit for fixing up any not-historic building that was put into service before 1936. That's just to save older building stock in general.
Why is this credit so important for making these projects happen? A 20% discount sounds nice, but is it really a game changer?
It's way more than just a discount. The benefits are structured to create a reliable cash flow stream for the developer over 6 years. Historic rehab is incredibly expensive and risky. This reliable cash flow from the credit stabilizes the financing and makes the whole project attractive to big institutional investors who would otherwise just build something new.
Okay, now let's move to probably the single most influential economic engineering tool of the last 20 years. The Renewable Energy Investment Tax Credit, or ITC. This has completely changed the energy industry.
The ITC is all about upfront capital investment. For solar, fuel cells, and small wind projects, the credit is a massive 30% of the cost. And crucially, for big utility-scale projects, there is no maximum limit on that credit.
So if you're building a billion-dollar solar farm, that's a $300 million tax credit. That's enough to completely rewrite the financial model of the project.
It is. Other technologies, like geothermal or microturbines, get a 10% credit. So this tiered system shows Congress actively picking winners, pushing solar and wind hardest.
And tell us about the timeline. These things are always on the verge of expiring, right?
Constantly. The sources point to the big extension in 2015, which kept the 30% credit going through 2018 before it started to phase down. Developers get the credit plus accelerated depreciation, which gives them a great cash flow advantage over 6 to 8 years.
There's a really important technical detail in that extension. Eligibility was based on the date construction started, not when it was finished. Why is that little bit of wording so important?
It is economically vital for these huge multi-year projects. A big wind farm might take 3 years to build. If the credit was based on the completion rate, no one would start building because they couldn't be sure the credit would still exist when they finished. Basing it on the start date provides financial certainty and triggers this massive rush of investment right before the deadline.
And the sister incentive to the ITC is the production tax credit, or PTC. So the ITC helps you build it. The PTC rewards you for running it.
That's it exactly.
Yeah.
The PTC is production-based. You get an income tax credit for every kilowatt hour of electricity your facility generates from sources like wind or geothermal for the first 10 years of its life.
And what's that worth?
It started at 1.5 cents per kilowatt hour back in 1992, but by 2013 it was inflation adjusted up to 2.3 cents. The 2015 extension for this was expected to drive something like $35 billion of investment for each energy type, wind and solar. The scale of economic activity directed by these things is just staggering.
Okay, shifting to social infrastructure. There's the low-income housing tax credit, or LIHTC. This is how most affordable housing gets built in the U.S.
It's a complex but brilliant financing system. The U.S. Treasury gives tax credits to state housing agencies based on population. The state then awards these credits to developers, but the developers don't use the credits themselves.
Right. They sell them, don't they?
They sell a future stream of tax credits to big corporate investors, usually banks or insurance companies.
And why do they do that?
Selling those credits raises immediate cash equity for the developer, which funds the actual construction. In exchange, the developer has to keep the apartments affordable for a long time. The corporate investor gets a guaranteed way to reduce their taxes for the next 10 years. It basically turns a future government tax break into immediate cash to build housing.
That is just a fascinating way to finance infrastructure. The government becomes a silent partner through the tax code.
And one last very specific example of this kind of financial engineering, the Qualified School Construction Bond, or QSCB.
So QSCBs are bonds that help schools borrow money cheaply for repairs or new buildings. But the structure is unique.
It is. Instead of the school district paying interest to the person who buys the bondholder gets a federal tax credit from the government instead of an indirect payment. This means the school can borrow money at almost zero interest because the federal government is effectively paying the interest through the tax credit.
And this is where the financialization gets really wild. The sources say the tax credits themselves can be stripped from the bonds and sold separately. Explain what that means.
So a bond is usually a promise to repay the principal and a promise to pay interest. With a QSCB, the interest is the tax credit. An investor might buy the bond but only really want the guaranteed federal tax credit, so they can literally strip that tax credit certificate off and sell it to another company that needs a tax break, and then sell the underlying bond, the promise of principal repayment, to someone else.
So the credit becomes its own tradable asset, completely separate from the original school bond.
Exactly. It shows the evolution of the tax credit from a simple tax break into a fully fledged tradable financial commodity.
So beyond those huge infrastructure credits, the federal government also uses credits to encourage specific business operations, especially around innovation and hiring. The research and development, or R&D credit, is a massive one.
It is. The R&D credit is designed to do one thing: keep high-value research and development jobs inside the United States. It's a credit for R&D costs that a company incurs domestically.
And it's pretty valuable, right?
Yeah.
Generally worth about 7 to 10% of your qualified research spending. What makes it so strategic for businesses, especially for startups?
It's the flexibility. Normally, you'd use a credit like this to offset your corporate income tax, but what if you're not profitable yet?
Which a lot of startups aren't. They're just burning cash on R&D.
Exactly. So for them, the credit would be useless. The brilliant part is that the R&D credit can be used to offset their payroll taxes instead.
Ah, so it becomes immediately valuable. Gives them cash relief on their employment costs right when they need it most.
It's a clear signal that the policy is about incentivizing the activity of research, not just rewarding companies that are already profitable.
And then moving to the labor market, there's the Work Opportunity Tax Credit, or WOTC. This is a very socially focused credit.
Highly targeted, yes. The purpose of WOTC is to give employers an incentive to hire people from groups that face really high unemployment rates. We're
Yeah.
talking veterans, at-risk youth, people with disabilities.
And the employer gets a tax benefit that's directly tied to how many hours that new employee works. It's a reward for taking on the extra risk or training costs.
It is. And the history of WOTC also shows how these credits are just perpetual political footballs.
How so?
Well, it was created in 1996, but it's always expiring and then getting renewed retroactively. The sources mention it being extended in late 2014 and then again in 2015. This constant cycle of expiring and then being brought back to life shows, both its political importance, but also the constant debate over whether it really works or if it's just a subsidy for hiring that would happen anyway.
And just to give everyone a sense of the sheer scope, we should probably mention some of the other federal business credits. There's credits for alternative motor vehicles, for producing alternative fuels.
Disaster relief credits, and all sorts of credits for hiring people in specific geographic areas like economically distressed zones. The federal government really has a credit for almost everything.
And if the federal system is complex, the state level must be a total mess. The sources say something like 43 states have their own special incentive programs.
It's an absolute patchwork, and it creates this intense competition between states. You see credits for cleaning up polluted brownfield sites, for film production to attract Hollywood, for renewable energy, for historic preservation. And they all have different rules, different values.
And this is where the marketability we talked about becomes so important for attracting capital into a state. How are these structured so they can be bought and sold?
Many states will literally issue a tax credit certificate that you can buy as an asset. The investor buys the right to reduce their future state tax bill.
And who's buying these?
They're very specialized financial products. The buyers are usually institutions with huge, predictable state tax bills. Think big banks or insurance companies. They can use these credits not just against their income tax, but often against things like a state's insurance premium tax. They buy the credits, often at a slight discount, as a guaranteed way to lower their tax payments.
Let's use the example from the sources. The Oregon Residential Energy Tax Credit for solar systems. The numbers there tell a really interesting story about success and political will.
They do. The RETC was clearly working. In 2015, the state gave out over $12 million in these credits. That was up from just $4.2 million the year before. So that tells you there was a massive boom in solar installations.
But wait, if it was working so well, why did the governor's budget proposal in 2017 want to let it expire? Why pull the plug on a successful program?
That is the fundamental tension. It's policy success versus budget cost. Even though the solar industry said the credit was their top priority proof that it was driving behavior, the governor ultimately decided it was just too expensive for the state budget to keep subsidizing solar at that level.
That is the perfect example of a credit's life cycle. It's created to change behavior, but if it gets too successful or the cost gets too high, the government can just decide it's over. It's a continuous high-stakes negotiation.
Okay, let's broaden the lens one last time and look at how credits work in a couple of specific international and alternative tax contexts. We have to start with the one we touched on earlier, the value-added tax, or VAT, input credit. Why is it so fundamental to global trade?
The input credit is the absolute lifeblood of any VAT system. It's what makes it fair. As we said, a business collects VAT on what it sells. That's output VAT. But it also pays VAT on what it buys. That's input VAT. The input credit is what ensures tax is only paid on the value added at each step.
Let's use a simple supply chain example to really nail this down. Okay, so a furniture maker. They buy lumber and they pay, let's say, $100 in input VAT to the lumber mill. Then they sell the finished table to a retail store for a price that includes $500 in output VAT.
Okay.
The furniture maker only sends $400 of that VAT to the government. The $100 they already paid on the lumber acts as a credit against the $500 they collected. So the tax is correctly applied only to the value they added, which is $400 worth.
You mentioned the refundability is critical here, especially for exporters.
It is. If that furniture maker sells their table outside the country, outside the VAT zone, they collect zero output VAT. But they still paid that $100 in input VAT on the lumber. In that case, the government has to refund the entire $100 input credit to the furniture maker. That ensures the product leaves the country completely tax-free and can compete on the world market.
Okay, now for income tax. Let's talk about the foreign tax credit, or FTC. This is all about preventing double taxation, right? It's essential for any country like the U.S. that taxes its citizens on their worldwide income.
Exactly. So imagine a U.S. architect goes to work in Germany for a year. She's going to pay German income tax on her salary there. But because the U.S. taxes worldwide income, she still has to report that same salary to the IRS. Without the FTC, she'd get taxed twice on the same money.
So the FTC lets her claim a credit for the German taxes she paid, either through U.S. law or a specific tax treaty.
Right. It prevents that double hit.
Yeah.
But here's the crucial limitation. It is non-refundable, and it's strictly limited. You can only use it to reduce your U.S. tax bill on that foreign income down to zero. You will not get a cash refund from the U.S. government if the German tax rate was higher than the U.S. rate.
So if her tax rate in Germany was 40%, but her U.S. rate on that same income would have only been 30%, that extra 10% is just lost. It's about relief from double taxation, not getting a refund.
Correct. It's an administrative tool to make two different countries' tax systems play nice together. It's not a subsidy.
And finally, let's look at credits in systems that have an alternative tax base, like the old U.S. Alternative Minimum Tax, or AMT. These systems have a regular tax, but also a second parallel calculation that might result in a higher tax bill.
Right. The whole point of the AMT was to make sure that high-income earners couldn't use a ton of deductions and loopholes to pay zero tax. If the AMT calculation came out higher than your regular tax calculation, you had to pay the higher AMT amount.
And the credit comes into play when you pay that higher AMT amount.
Yes, the amount of extra tax you paid because the AMT becomes a credit. But, and this is key, you can only use that credit against your future regular tax bill, and only in a year when your regular tax is higher than what your AMT would have been.
So you pay the minimum tax now, and you essentially bank the extra amount you paid as a credit to use in a future higher tax year.
It's a way to enforce a minimum tax rate year to year without permanently overtaxing someone. You get the money back eventually, but only when your income is structured in a way that you'd be paying higher regular tax anyway. It's complex, but it's designed for long-term fairness.
So we have come through this whole deep dive into the architecture of tax credits, and I think the big picture that's emerged is that this is really less about tax relief and more about setting government priorities. What's the unified summary of the spectrum of power we've just seen?
Well, we've seen this mechanism function across just an incredible spectrum. On one end, you have these really sophisticated social engineering tools, the refundable earned income credit or the old UK tax credits. They target poverty, they subsidize education. They're really just efficient cash transfers delivered through the tax return. They completely blur the line between tax policy and social welfare.
And then, on the complete other end of that spectrum, you have these massive economic incentives that are driving infrastructure. We talked about the renewable energy ITC, the historic rehab credits, the low-income housing credit. These are basically government contracts for private action. They steer billions of dollars in private capital toward public goods like clean energy and affordable housing.
The key takeaway for you, for the learner, is this. Tax credits are the government's single most effective and nuanced tool for steering behavior. It doesn't matter if it's individual behavior like saving for retirement or adopting a child, or if it's corporate behavior like building a wind farm or hiring a veteran. The credit is the financial carrot they use to signal what's a priority and to reward you for complying.
But the success of these credits, it often comes down to their structure and their complexity. And that brings us back to our final provocative thought about that financialization we talked about.
Right. We saw that with things like the qualified school construction bonds or the state-level credits, the tax credit itself can be stripped off and sold as a separate marketable certificate. And when tax credits get that complex, when they're openly traded like a commodity, they stop being a simple tax relief for the school or the developer. They become these sophisticated, tradable financial products.
Which raises the big question. How much of the actual benefit of that credit goes to the intended target, the developer who needs the cash, the school that needs the funding, and how much of it just gets captured by high-income investors who are buying these credits at a discount to lower their own massive tax bills? It's that fascinating intersection where public policy meets high finance, and it's always worth asking who the true beneficiary of complex tax law really is.
Something to think about the next time you're filing your own taxes and you see that dollar-for-dollar reduction finally kick in.
Until next time, stay well informed.